started drinking a little bit of that. Good. I had a couple drinks. I was yelling for people out there. Oh, I know. Was I yelling before? Too loud? I don't know. I've been talking. I don't know before.
Hello, welcome everyone. Let's get started. Welcome out everyone. Thank you for coming. Can I get everyone's attention, please? All right, hey, my name is Rob Nickester. I'm one of the hosts here. This is Commercial Real Estate Mastery and More. Myself, Rob, David, Yoshi, Juan, and Nick are the hosts tonight. Thank you all for helping put this together. Thank you everyone for coming out. We hope to teach you something tonight, as well as have a great night, have some drinks and network, meet some new friends, possible partners. Thank you again for taking the time to come out and spend some time with us. We've got a couple speakers tonight, Tyler and Colton from Worldwide Commercial. They're going to speak on the local state of the economy, inflation, what deals are looking like, maybe cap rates, and we're going to spend about 15 minutes doing that. If you've got some questions, those are guys to hit up. Love for everybody to come around at the end, talk to all your hosts, meet as many people as you can, drop business cards. That's what we're here for. And enjoy. So,
guys, I just want to add also as well, thank you everybody for coming out. There's a couple photos on the tables around here that say scan me. At the end of the evening or at some point throughout the night, scan that. It's just 3 questions. We would love to get your feedback on what content you guys would like to see at future meetups. Also, next month, we're going to be hosting a commercial broker panel. Up here, we're going to have 4 representatives from different brokerage firms. I'd love to understand what sort of questions you want us to ask on that panel. So please just scan that. It's really quick 3 questions to take care of before the end of the evening. Thank you again.
All right, once again, thank you. And without further delay, we will get started and hand it off. Thanks again.
I'm Tyler. This is Colton. Like you said, we're from Worldwide Commercial. We're a boutique brokerage firm here in Frisco. We operate in all the major markets: Dallas, Houston, San Antonio, Austin. Yeah, we'll dive in some slides. It's not going to take very long. Just got some interesting data. CoStar's updated their quarter data from what's happened in the last Q1. We're going to give us some insights on what we're currently seeing on offers on properties right now. If Nick, if you want to pull slideshows up. Oh, you're good. Keep in mind the data we're about to show is from CoStar. They lag a little bit, so some of our inside information is probably a little bit newer updated to this. But this is something with the new construction deals. We'll be real quick here, but basically the blue line is net deliveries, so new items or new properties coming to market here soon. And then the orange line is absorption rates. So as you can see, as we're in 2023 heading into 2025, the amount of deals that are coming to market is decreasing drastically. That has to do with a lot of different things like construction, loans with high interest rates, and the cost of supplies, whatever, and absorption's coming up. So basically in 2025, we're looking to be in potentially a pretty bad supply and demand issue, which is going to help the rent. And vacancies are going to be starting to come back down, and properties are going to be filled out.
Yeah, and on this slide, we're going to have the rent growth, which we are basically back to historic norms of about 2.5%. At the peak back in 2021, we were seeing as high as 15%. So that's kind of where the trading kind of began, of people just flipping properties back and forth. They were kind of riding this wave up right here, and you see properties just kind of trade over and over and over again. But we do expect some negative growth over the next maybe year or so and a half, and then kind of pick up historical norms again back in 2025. As far as the class of assets that are kind of been struggling, A class has kind of slowed down a lot more compared to the B class assets. The B class are kind of leading the way with rent growth still at about 4%, so still above the historic norms, but the A class is kind of taking a little bit more of a hit.
So this is a lot of data here. You guys can snap a picture, give me your card later. We're gonna send this out via PDF, but this is something that a lot of people don't realize. A lot of people are putting too much focus on interest rates, but the real problem is expenses. Expenses are outweighing rent growth. You got insurance almost doubling in a lot of markets. You got the maintenance guys' salaries increasing by drastic rates. But like Colton just said, I don't know if that's, if you got, that might help, just closer to my mouth. With the expense rates growth, it's way outpacing the rent growth, right? So what Colton's talking about is this rent growth coming back to basically 3% when expenses are growing upwards of 20%. With this, a lot of people are pointing fingers at the interest rates being a problem, but to me, this is the problem, right? These are direct hits to NOI. It's a drastic impact on your property, and it's a reason why asset management is so important to stay in front of items like this. But I know it's a lot of data. These are broken out by price per square foot on the sub-market. I'd be happy to send out if you guys just give me your card later.
And then right here we have the sales volume. So have y'all been seeing the same amount of deals that you've seen over the last maybe 2020, 2021? Probably not quite as many deals coming through, right? Yeah, so as we can tell from the orange bars, I mean, there was obviously a lot of sales volume in 2021. Like I was saying previously in the rent growth, everyone was kind of trading properties back and forth. And now we have seen a decline. This little small orange bar, that's where we're at now, which is not a lot. And despite that bar being so small, the DFW area is still, the most transacted market in the country. So that shows you how slow pretty much everything has kind of come down. And even despite, the low transaction volume, we're still not seeing prices really dip at all. So that could also be kind of what we go back to with expenses, is that the expenses are still rising, but the price per door has pretty much stayed the same, which creates that stagnant environment that we are now currently seeing.
So this might be a shock to everyone because it's kind of somewhat contradicting, but tells the story. So there's not many sales going on, but the reason why are the sales that are happening are probably at a cap rate that you guys are not probably willing to pay. All the deals that have closed in Q1, this orange bar is technically supposed to represent Class C deals. Blue bar, Class A. So we like to ride the 80s and newer, this green line. If a deal is actually closing this year, it is still a sub 5 cap. We're looking at 4.7, 4.8 cap rates to actually get a deal done. When I talk about those cap rates is most of the time offers are coming in right around a 5 cap with a trailing T12 financials. The 4.7 is adjusted, right? So these are adjusted cap rates with insurance and taxes ahead. But like we said, a lot of people are trying to submit offers in this 5.5 cap range, and that's not going to get a deal done. The ones that get deals done are the 4.7 caps. Those are the offers that are getting counters. And I know that's not what people want to hear, but that's reality. If you really want to get a deal done, you got to be a sub 5 cap.
So what we've been seeing as far as, we've been doing quite a few BOVs lately, and this is not your grandmother looking at her healthcare bill. This is owners receiving our BOVs. So this is kind of the story. This is kind of like building a timeline out of kind of what we're seeing throughout the quarters as far as what's going on with transactions. And we called Q1 pretty much the quarter of BOVs. Everyone is kind of wondering what their properties were worth. Everyone is real concerned as far as what they might have paid for the property and how it's performing, and seeing expenses going up, and then potentially, property values drop as NOI drops as well. But that is, the owners looking at the BOVs currently. And once they got our BOVs, they kind of, most owners kind of sit on them for a little while, and this is, they think everything's kind of fine, They're not really exploring options potentially. But yeah, that's kind of a lot of the take of some owners right now that we have seen in the market, as you've also seen kind of foreclosures happening recently. There's been some big news, so that could have been what they were like. And then we got Q3, Q4. We've been hearing from buyers that, they expect opportunity to kind of open up around then. So with, maturing debt and all that kind of happening, and potentially opening up some opportunities, maybe some sellers kind of finally, realize their properties aren't performing, maybe waiting isn't the best choice, and now that is a buyer looking at the struggling owners.
So no more of the slides and data, we'll just get into kind of what we're seeing. So the big question today is the price gap that's in the market. We're seeing about 10% difference, right? Sellers are wanting X, buyers are about 10% lower. Basically, how to bridge that gap and start getting creative to figure this out would be, there's basically two different types of deals in the market right now. There's distressed assets and there's performing deals. If you guys are underwriting deals to receive a cash-on-cash return of 5-6%, whatever that is, that means you're trying to buy a performing asset. If you're trying to buy a performing asset, like we saw in the cap rates, there's no discount available. Sellers will not decrease their price to adapt to the buyer market if their asset is performing. If you guys are wanting a discount on the property and get to that 5.5, 6 cap level, you're going to be buying a distressed asset. That distressed asset means there is no cash flow year 1, year 2. You need to come in with a good CapEx plan, a good asset manager, a good property management company, and implement that plan, and then that cash flow starts kicking in maybe year 2. So ultimately, in the last 5 years, people would underwrite multifamily deals to transact, and their hold period would be about 3 to 5 years. So to hit the numbers, to hit the IRR numbers, you need to increase that holding period time, and you need to be able to hold between 5 to 7 years for the IRR to catch up to make the deal work. That's how people are still getting deals done at 4.8 caps or 5 caps, is they're not underwriting to a year 1 cash on cash return. They are delaying that return and getting an average of 6% over a longer period of time.
Yeah, so I'll go into kind of how they are also structuring these deals, or at least the most important component is the earnest money. We've been seeing on LinkedIn or even buyers talking that there's no need to put earnest money down right now in this market, but that is not really what we've seen, at least with deals that are getting either, at least entertaining the owners. A lot of times they won't even entertain a lot of these offers if they don't have earnest money attached. So what we're typically seeing is anywhere from, 50 basis points to 100 basis points of earnest money put down, and then half of that typically what we will see is goes hard about after a week. So that's kind of the structure that we're seeing. As far as performing assets go, it might be different if it's an unperforming asset, but performing assets, you're going to have to put that earnest money down to even entertain the owner.
So to kind of recap what we're talking about, trying to keep it quick, want to keep this open for Q&A, but to get to the bottom line of all this data is, right, if you're a seller in this room, or no sellers, right, if you have a distressed asset with expenses outweighing income, sell now. The property is not going to increase in value. As we saw in recent news, there's been some pretty heavy hitters foreclose on a lot of deals in the last couple weeks. I know them personally. They've gotten BOVs from us. They've gotten BOVs from multiple brokers in the market. The reason why they foreclosed is because they were holding on, thinking this miracle capital was going to come in, and it didn't, and that property just declined. It was one of the biggest foreclosures Texas has ever seen. That's unfortunately not going to be the last foreclosure that we're going to see. There's going to be a ton more coming, basically because what we're seeing is these distressed sellers they're reluctant to have the conversations with their LPs that they're not going to get these returns that they've promised. So they try to hold on, they try to keep it private, banks come in, and then ultimately to get a property foreclosed on, you see a bunch of negative PR that hits those owners, right? The last foreclosure was on the front page of the Wall Street Journal, and he's a student of a local guy that's here in the Dallas area. It's not good PR. If an owner decides to sell, yes, they might lose some money or whatever, but that sell is privately done, right? The foreclosure is going to generate a lot more negative PR than a sell and addressing your LPs like you're supposed to and informing them of the market and where they're at today. With that, one more topic I'd like to say before we open to questions is there's a lot of people pointing fingers, like I said, at the interest rates and expenses. But ultimately what we see as brokers, the biggest issue in the market is lack of asset management. Any owner operator that I know personally that has a good asset management in place or a good team in place, they've been able to navigate this market of increased interest rates and increased expenses in order to hold on to that property longer and deal with this nasty market that we're in. So with that, if you're an LP in this room, be really, really particular on who you're investing with and understand where they're coming from. And in order to do that is something as a broker I like to tell everyone in this room, if maybe you're looking for your new first deal, don't be so broad on what you're looking for. So if I walk around this room, I could say probably 80% of you are going to tell me you're looking for 80s and newer and 100 units and above. As brokers, we laugh at that, right? There's hundreds, thousands of you telling us this information. Get more specific, narrow down the exact submarkets that you want, why you want those submarkets, and maybe even decrease your unit count, right? Get more specific with the brokers on why you want that deal, the markets that you're looking for. That's going to increase us to be able to put you on our buyer list above our top buyers that we already have. Because realistically, if you go around Dallas, talk to any broker in the city, if you say those statements, I want 150 units, 80s and newer, blah, blah, they already have their top 5 guys. They already have their top 10 guys. So you got to get way more specific and explain to people why you want those deals. But I'd like to open it for questions, just kind of keep it brief. So David here wants to know kind of like what the capital stack's looking like. So if people are getting these 4.85 cap deals, in the past we've seen people underwriting deals to 75, 80% LTV. That's not the case anymore, right? So basically we underwrite deals before we go to market at 60%, 65% LTV, which means you're going to have to raise a lot more capital on those deals. That means, you know, maybe you were looking at a $30 million price tag 2 years ago, but you're going to have to lower that price tag, which maybe means lower that unit count. You're going to have to raise essentially a lot more money. Pref's still in play, but pref and mezz is getting really expensive, and you really need to basically be able to come up with a lot more upfront capital to get these deals done.
One thing I've been hearing is that a lot of the lenders are requiring much larger reserves on income assets. Could you tell me how that's affecting cash buyers versus people who are doing financing?
Yeah, I think Antoine kind of talked about this a little bit last month, but the reserves are starting to somewhat pull back, essentially, is what we're hearing, right? As the interest rates are increasing, lenders and agency lenders are starting to kind of pull back on the reserves as this economy is getting fixed. So we're hoping that's not going to be as big of an issue moving forward. But yes, right now we have been kind of underwriting in-place reserves of what those lenders have need, which on the distressed assets is part of the reason why those cap rates are starting to come up. But those reserves are supposed to be scaling back here soon and kind of shortening up, which will be able to help save a few people. That the reserve money is going to get released back into their deal.
So is any specific markets more distress?
So Nick's asking, is any market looking more distressed in Texas than others? And I'd say absolutely. I was actually going to touch on that. All that data you saw was based on DFW. We are seeing way more distressed assets in Houston than we're seeing in Dallas. Like Colton touched on, Dallas is probably still the #1 volume city in the United States. as we're talking with owners and doing BOVs, we are seeing more distressed deals in the Houston market. San Antonio and Austin, not so much, but Dallas is probably leading the market with performing deals. The reason why is there's been a pretty big occupancy drop in Houston lately, and the deals we've seen struggling are C-class deals, which is typically 70s and 60s product. The kind of 90s and newer we've seen kind of be okay. But yes, you're right. That Houston market has had a lot more distress, and I think that has to do with this occupancy drop, and the big issue has been insurance. Insurance in Houston's gotten absolutely skyrocketed. I mean, we're seeing basically double, triple rates.
We're underwriting to what? I think we were underwriting to about 850, 900, maybe 9 months to about a year ago. And now we've been hearing quotes of $2,000 or more. So that's a $1,000 increase, and over 12 months, that's $80, $90 per month on that unit. So you'd have to incorporate some sort of value add to try to at least make up that spread to kind of close that gap. So yeah, insurance is a heavy problem as well.
That's been pretty varied on a class basis, but current BOVs that we've been seeing like current operations kind of like 600, 700 a door. I've personally been kind of underwriting towards the 850, 900 on the kind of the 90s and newer assets. But what we've seen if you like that expense tab that I kind of pulled up earlier, it's really, really heavily dependent on submarkets. Like Fort Worth has a way higher insurance rate than McKinney. And I think that has to do with a lot of historical rates and storms and things like that, but it's nowhere near the Houston market. So Nick asked me, how many BOVs are we doing that is actually coming below the debt value of the properties? In Houston, it's quite a bit. We're pushing probably like 80% of the properties that we're performing values is going to be less than the current debt owed on the properties. And Dallas, like I said, it's not that bad. It's maybe, we've seen a lot of properties come in right at the debt, maybe a little bit more. But the Dallas deals, maybe they've had the ability to recap or raise more capital and can kind of hold off to 2025 because they're being able to service that debt. There has been some struggling owner operators in Houston that haven't been able to service it. And then on top of that, when their value's coming in lower, that's when you're dealing with the situation that happened last week and the bank steps in and forecloses it. So it just kind of depends on the market there. So you're asking if kind of the hard money is indifferent based upon markets are kind of leveling out and based on how. So I can touch on retrades, but I'll let Colton talk on the earnest money here.
So you were asking essentially the dollar amounts or percentage amounts? I mean, it's really about 0.5% to 1% of the total purchase price. So if you have a $10 million property, yeah, it's looking probably around $100,000 or so for that earnest money. Yeah, so right around in that range on the 1% high end, $100,000, probably to $50K.
And he's talking performing deals, right? So if you're trying to win a performing asset, we are still seeing non-refundable earnest money being deposited probably within 3 to 7 days of the deposit. And that's what he's meaning is basically 50 basis points. In Houston, we've seen kind of a scale back from that. People are getting creative and maybe going a more staggered approach, right? Like I'll deposit 25 grand, I'll go hard at 7 days, another 25 grand at 14 days. And it's kind of getting a little bit more creative there. As you saw in the sales volume, as far as retrades go, a lot of properties fell out of contract in Q4 of 2022 due to those retrades. But now what we're seeing is if someone's getting a signed LOI or going under contract at today's terms, either the seller's willing to play ball or the agreements have been pretty much in place. So the retrades have maybe slowed down a little bit, if it even gets to the contract point.
Of the BOVs that you're doing, roughly how long have they been holding the asset?
It's a good question. Been pretty consistent. Most of the distressed assets have been bought in 2021, right? We're at the top of the market. You're looking at 80% leverage, floating debt, no rate caps or expiring rate caps. So that basically 2021 transactions is what we've been seeing. The ones that have been closing at the 4.8 cap rates, 5 cap rates, those owners have probably owned those deals a little bit longer. So their appreciation is capitalized and they're getting a return on their dollar.
Of the deals that you closed this year, how many of them came in at your BOV?
This year, none. I mean,
Higher or lower? They came in higher or lower?
from what we've talked about with other broker friends in the market and stuff, pretty much everyone's lower, right? Closing a little bit lower. Yeah. So keep in mind, though, that the BOVs, kind of like what Colton was talking about, what's happening currently is a lot of BOVs were provided in Q4 of 2022 and Q1 of 2023. So what's going on is these BOVs were provided 5-6 months ago, and the market is changing on a weekly basis. And like we talked about, the expenses outgrowing income, a lot of these owners are circling back up with these brokers and saying, okay, well, now what's my BOV? And all these BOVs are getting lower and lower and lower. So it kind of goes to my point of if you do have a distressed asset or whatever, now's the time to sell it.
Thank you, Tyler and Colton. That was some fantastic information. Can I just get our hosts up here real quick? Nick, can you come up here? David? I just want our hosts to stand up here real quick so that you see our faces. We put this together, Nick, Juan, Yoshi, myself, Rob, and David. And if we don't know you, please come up and introduce yourself. We want to know each and every one of you. We are here to network. We're here to create friendships, create partnerships, to make new connections and find deals. And the saying goes, a rising tide raises all ships. So let's do that tonight and meet some great people and have a good time, have a few drinks. And thank you again for coming out. It's been wonderful.
Great questions. I love that. Let's just get them.